Thanks for clicking. Canada's fixed mortgage rates continue to rocket upwards in October, as spiking bond yields put upward pressure on Canada's cost of borrowing. And the surging bond yields come amid what would have once been considered good news for Canada's interest rates, with inflation coming in lower than expected and retail sales slowing, leading many to argue that the Bank of Canada is going to be holding on interest rates at its Wednesday announcement. And while the bank may indeed hold at its Wednesday announcement, the bond market, which dictates fixed rates,
says who?
Bears repeating, the bond market, which dictates fixed rates, doesn't appear to care, with yields up over 30 basis points since the last time the bank held on rates. And with fixed rates continuing to surge upwards, growing stress is being put on affordability, with buyers now having to qualify at 8+%. This is putting major downward pressure on prices. So what I want to do today is go over my best fixed mortgage rates for the month of October, briefly take a look at what is sending yields higher, discuss changing affordability, and then go over what to look for next. Speaking of next, the Bank of Canada is going to make its decision on Wednesday and release its monetary policy report, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. On to the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down. You qualify at the contract rate plus 2% or 5.25%, whichever is highest. You have a 25-year amortization, and you pay the mortgage insurance. My best 5-year fixed insured rate in August was 5.44. That jumped to 5.64 in September, and as of now is sitting at 5.84. With a 5-year insured variable rate mortgage sitting at prime minus 1.05 or 6.15%. So that's about a 20 basis point increase in just 1 month, but that's a 150 basis point increase since April when the spring real estate market started to take off, back when the CREA called the top of interest rates and the bottom of prices.
In hindsight, was utter nonsense.
Next up, my best 5-year fixed insurable mortgage rates. Insurable mortgage rates is where you have 20% down. You qualify at 5.25 or 2 points above the contract, whichever is highest. You qualify at a 25-year amortization, and you don't pay the mortgage insurance. My best 5-year fixed insurable in August was 6.09. That jumped to 6.19 in September and is now sitting at 6.39, with a 5-year variable rate mortgage sitting at prime minus 0.5 or 6.7. So again, we're up about 30 basis points in August, but we're up 160 basis points since April.
But everything is going to be different now.
And finally, my best 5-year fixed uninsurable mortgage rate. An uninsurable mortgage rate, that's where you do a refinance or an equity takeout or a purchase price over $1 million, or you have a 30-year amortization. You qualify at 5.25 or the contract rate plus 2%, whichever is greater. You have 20% down, and of course, you don't pay the mortgage insurance. My best 5-year fixed uninsurable in August was sitting at 6.19. That jumped to 6.29 in September and is now sitting at 6.39, with a 5-year variable sitting at prime minus 0.4 or 6.8%. So, uninsurable rates up about 10 basis points last month, but again, up about 150 basis points since we looked in April. So we have 5-year fixed rates all up about 20 basis points since September, and all up about 150 basis points, 1.5%, since April when the real estate market started to take off. And I brought up how much mortgage rates have risen since April, not just to poke fun at the CREA.
That's part of it.
But also to point to the importance of bond yields. The Bank of Canada announced its conditional pause in March, held in April, and has since raised interest rates by only 50 basis points. Yet, yields are up about 130 basis points, and, as we saw, mortgage rates are up about 1.5%. Much higher than the only 50 basis point increase that we've seen since April. And, very briefly, the reason for the disconnect between the Bank of Canada's policy rate and the 5-year Government of Canada bond is the surging borrowing cost in the US, where the 10-year Treasury yield just hit 5% for the first time since 2007. And while we've gone over the reason for surging US yields in other videos, and probably will again, suffice to say that borrowing costs in the US are rising as investors are demanding a premium due to the loss of purchasing power brought on by higher inflation, China selling off US debt, and continual increases, and I mean continual increases, in US debt needs.
There's no money.
Regardless, none of these dynamics, U.S. inflation, Chinese foreign policy, or U.S. debt needs, are within the purview of the Bank of Canada, and if none of these change, we can expect rates to remain elevated. As such, there are some real concerns about the growing unaffordability of real estate in Canada, with buyers having to qualify at rates close to 8%, or more in some cases. In April, the average price of a home was sitting at $716K. At that time, borrowers had to qualify at 6.49, and the income needed to buy that average price home was $165,000. Fast forward to right now, and borrowers now have to qualify at 7.84, 2 points above the 5.84 that's available. Again, using minimum down payment requirements on an insured mortgage, that $165K only buys a home worth $640,000. So, since April, buying power has decreased by about $76,000 to get that average price home, and, all things being equal, we're seeing very few signs that it's going to be getting any better anytime soon. And this loss of buying power is important. If the Bank of Canada holds on rates on Wednesday in the usual suspects, again, call for the top of interest rates, again, we need to be aware that there are forces way outside of our control, way outside of the Bank of Canada's purview, that are pushing up the cost of borrowing, that are putting downward pressure on the ability of buyers to purchase. While the cause of this increase in the cost of borrowing is global in nature, the effects will be felt locally. The effects will be felt on our local real estate markets. We've already seen the average price drop down to $650K, down from the $716 that it was sitting at in April, and all things being equal, if we don't see a major change, if we don't see a change in U.S. debt needs, in U.S. inflation, in Chinese foreign policy, absent a major black swan event where everyone piles into treasury yields, if they do, that's a discussion for another time. Absent any of that, if we don't see any major changes in U.S. policy, in 5-year government bond yields, expect prices to continue to fall. With that said, the bank is expected to make its much anticipated interest rate announcement on Wednesday, and we'll obviously have an update out on that announcement on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.